All right, so chapter 11.5 is going to be the disposal of fixed assets, especially what do we do with them when we don't need them around anymore or we need to just dispose them, right? Well, when you need to get rid of them, there are a few things you can do. You can either sell the asset, right? You could just simply just get rid of it, or you can actually exchange or replace the items. So those are the three ways that you can have a means to just get rid of your items off your list and so on and so forth, right? Most popular one is to sell, but once you use your asset long enough and you're trying to sell it for scrap metal or try to sell it for a high price, you're most likely not going to be able to. The best one is simply just write it off and get rid of it off your books, or you can exchange it. So there is a way that you can, a lot of programs out there, such as for vehicles and auto dealerships, they say, hey, bring in your used car and you can trade in that value to get a new car, something like that, right? So let's talk about how to actually dispose an asset. Well, first off, you need to determine what your book value is. So that's the purpose of us creating our depreciation tables, because then we'll get to have a book value. Once we determine what that book value is, so that's what should be what your asset is currently worth at that given moment in time. What you're going to do is you're going to, if you choose to sell your item or to get rid of it, you're going to recognize one or the other, a gain or a loss. Okay, so a gain is if you sell the item for cash and it's more than what the fair market value of the book value is that's currently in your books. If you sell it for less than that, then less than the book value that you have on your books, then you'll take a loss. Pretty straightforward, right? Most commonly, when you do sell your fixed assets, especially if you used it, it's much more difficult to get a gain out of it, but you're most likely going to take a loss out of it just because, again, people don't want to buy used items for a higher price value. They would want to haggle, or they would, buy it for what they think it's worth, right? Which is less value because they want the cheaper deal. Okay. So let's go ahead and talk about making this checklist so then we can go ahead and properly dispose our assets. So number one, we're gonna obviously figure out what the purchase price of the fixed asset is, right? We're gonna determine the amount of depreciation, right? So when you choose to sell your assets. So if you're using it for a couple years, right, you're going to determine how much depreciation and how much the book value is at the end of that given accounting period. Then you're going to receive payments for that's going to go against the book value, which is you're going to recognize the gain or loss, and then you're going to remove the asset from your books. Okay, so let's go ahead and take a first example here. Let's say example one, on January 5th, okay, you decided to purchase a machine for $50,000 and, okay, which is what you placed on a credit card, okay, assume that all fees and taxes are included, okay, so record the purchase of the fixed asset. So here, I bought a fixed asset using my credit card, okay? So whatever it is, maybe I bought equipment because it was a machine, right? I bought a machine for $50,000 and I bought it on a credit card, okay? The payment we don't care about. We care about just making the purchase of the fixed asset in the first place. So therefore, now that I bought it, right, and we bought it on January 5th, so our assumption is if we do depreciation at the end of the year or at the end of the month, right, we'll start calculating as of January, okay? So in this case, we're going to do monthly depreciations. So in this case, right? We're going to be using straight line to record the depreciation for the first month. So let's say we had it, we put it into service as of January 5th. So we're going to depreciate for the very first month. So this is how it's going to be, right? Using straight line, straightforward, right? It's your asset cost minus salvage value. So in this case, we have a salvage value of $5,000, right? Because it's a machine. And we're going to say that, well, at the end of its life, it should have a remainder of $5,000, right? And it's a 5-year, has a 5-year life. So in this case, right, we got 45,000. The rate is at 20% because 1 divided by 5 is 20%. So therefore, you're going to depreciate it for the month, right? You're going to divide that amount by 12 to get your monthly amounts, okay? So in reality, it's actually going to be a lot more than that. It's going to be X amount of dollars divided by 12, which you're going to get your monthly expenses to be $750. Then, of course, you're going to change the value into your book value because you used the asset for 1 whole month, which is going to give you $49,250. Okay? So let's say fast forward, right? That's what you have to do. You're going to journalize your depreciation with the depreciation expense and accumulated depreciation for the $750. Now let's say fast forward, okay, 4 years later, okay, and you decided to sell your machine to purchase a newer machine, okay. So on January 28th, okay, you sold your machine for $10,000 cash, okay. So record this sale of the fixed asset and determine whether you got a gain or a loss. So in this case, right, you're going to go into your books. You're going to look at your depreciation table, right? 4 years later, right, 4 times 12 months is 36 plus, 4 times 12 is 48 plus 1 extra month because you need to depreciate because you're going to depreciate an extra month because you sold it as of January 28th. You pretty much used it for that extra month of January. So here, this is what you're going to do. So you've been depreciating it every single month as usual, right? On the 49th month that you've had it, so about 4 years and plus 1 month, you're going to figure out how much your book value is. So in this case, right, you do your depreciation, and you've calculated that your book value right now is currently $13,250. Okay? And here's the problem. You sold it for $10,000. So in this case, you got the $10,000 cash, but actually how much your book value was $13,250, right? So in this case, we need to do this. We're going to take away the asset because we no longer have it anymore, right? You're going to use the historical cost of the $50,000 because that's what you originally have it in your books, is that you bought it for $50,000. You're going to also recognize the accumulated depreciation because this is what the amount that you used. You used 4 years and 1 month of the asset. So therefore, you have an accumulated depreciation of $36,750, right? Which makes your book value become $13,250. So in this case, if you sold it for $10,000, did you gain or did you make a loss? Because right now it's worth $13,250, but you sold it for $10,000. Did you gain or lose? You lose. So in this case, you're going to have to recognize loss on disposal of assets, which you're going to find the difference between the $10,000 and the $13,250, and you're going to get a $3,250 difference. So in this case, you're going to recognize that you lost money instead of gained it. okay? Because at the end of the day, it has to equal to the total amount that you have the asset for, right? You purchased it for $50,000. So now you sold it for $10,000 cash, but you end up using $36,000 worth, right? And you have to determine whether you made a gain or a loss. In this case, you took a $3,000 loss, okay? And that's how you get rid of the asset off your books, by selling it. Okay, so this is recognizing a loss. Okay. So let's do another example this time. It's the same asset. It is 4 years later, but this time you sold it for $15,000 cash. So once again, when we take a look at our journal, right, we're going to recognize that my asset was $50,000, right? I recognize that I got $15,000 cash. My accumulated depreciation was $36,750, which, right, at the end of the 49th month, right, it left me with a book value of $13,250. But I sold it for $15,000. So how much money did I gain out of that? I gained $1,750. Right? And that's what you have to do. This time, I'm going to credit this because I recognize that I increased income, right? I increased my income because I got a gain. Okay? I gained by selling my asset. So gain on disposal of asset. All right? So this one, okay, this one's okay? This one's clear? So this is what you do when you buy your assets, right? And why it's so important to utilize the accumulated depreciation, but this is how you get rid of it off your books. Okay? Any questions?
No.
Okay. So that's just disposing the asset by selling it. Okay. So let's talk about the next one, which is going to be whether for any reason that you want to increase the asset's life or increase the value of the asset, right? Yes, you can do some restorations, you can do some improvements on fixed assets, okay? So if you bought an asset, right, and it's slowly going down, depreciating very quick, and you don't want to let that asset go, right? So you want to keep using it because you think it's such a good asset, it's a good investment, and you want to add fixtures to it. Maybe it needs to go through maintenance, right? It's like we gave that example, right? You buy a very, very old car, you swap out the transmission, you swap out the seats for leather seats, you add another paint job on it, you're making the value of the car, right? Maybe it was a junk metal scrap car that you bought for $5,000 because you're changing the transmission, you're making it work again, you're revamping the seats and putting a new paint job on it. You are adding value to that old car that you purchased. And yes, it also works too. So this is one of the things that does go against the historical cost, because what are you doing? I'm deliberately trying to add value to my asset by either restoring or putting improvements on it. So yes, you can. So you could do any fixtures, any replacements, you could even repair it, or you could do some maintenance job on it. Okay? Those are just examples. Now, there are two ways that you can go about this. You can either increase the life of the asset, or you can actually change the book value of the asset. Because again, all of these things are going to cost you, right? But those are the two methods that we're going to be taking a look at. And it's going to be called the indirect and the direct method. But let's go ahead and look at the first one. Okay? So if on January 5th, right, you end up purchasing a machine for $50,000, okay, on a credit card, right, assume that all fees are included, record the purchase of the asset. So in this case, I bought the machine for $50,000, okay? And let's say 4 years later, right, you decided that you want to replace the engine, okay, motor, to improve your machines instead of buying a new one. Okay, so instead of buying a new one, you wanted to fix the machine so it can still work. Okay, so then on January 28th, you installed a new motor, okay, which cost you $10,000, okay, which extended the life of the asset by 3 years, okay? And it also increased the value, all right? If, okay, the current accumulated depreciation is $36,750 and the book value is of the machine is currently $13,250, record this improvement. So, how do we do that? Well, in this case, right, you're going to have your accumulated depreciation and you're going to add that cash. So what is this cash doing? It's lowering the accumulated depreciation. So therefore, instead of depreciating it that much, it's basically replacing it. So you're taking $10,000 off the accumulated depreciation and you're adding it back into your book value, okay? So that's what you're essentially doing. You're taking this fixture of $10,000 and you're basically decreasing the accumulated depreciation, okay? So how would that work in your depreciation table? Well, here's what we know, okay? You're still using straight line, right? The asset machine is still $50,000, right? And the salvage value is still $5,000, and you got 5 years, and you place into service as January 5th. Now, here's that one line I just read, right? On the 49th month, right? You currently have accumulated depreciation of $36,750 and the book value currently at $13,250. Because, right, this is the first one, because we chose to replace, or in this case, decrease our accumulated depreciation, that's going to automatically increase your book value. So this is what you have to do on that 49th month. Since you added the fixtures, right, of $10,000, you're going to adjust the accumulated depreciation, right? You're going to adjust this because you added $10,000 or subtracted $10,000 from it. It's now going to become $26,750, and that's going to automatically affect your book value because you just added $10,000 to the book value. So that means here's the two methods, right? How do I continue going on forth from here? You can continue going on saying, okay, that means the next month that I depreciate it will still be $750, but this time I'm calculating it straight ahead. All right? This is where I'm saying that it's going to continue going on from where I left off for my book value from that very month right there. Okay? So that's why this is one method that I can do. All right? I can also do a second method if I don't want to increase my book value. Let's say I want to increase the asset cost instead. So this is the second method. Right? First one was increasing the book value. Second one is increasing the asset cost. So you got the same exact scenario. You got that $10,000 replacement for the motor, but this time, instead of recognizing I'm going to change my book value, this time I'm going to add the cost to the asset itself. So in this case, I'm going to journalize that I'm going to increase my equipment by $10,000 cash. Okay? And how does this affect my depreciation? This one is where you're going to have to go back and you're going to modify everything because right now my asset cost is $50,000. You just increased it by $10,000 more. and it also increased its life by 3 extra years. So that's what you're going to do. You're going to replace these two numbers and you're going to plug it in. So instead of my asset cost being 50,000, it's now 60,000. And my asset life was 5 years, now it's extended to 8 years. Now, what does that mean when I'm already in the middle of my 4th year? When you're in the middle of your 4th year, that's okay. You're still going to increase your book value, right? Because right now when you go through the whole process, right? At the end of the 49th month, you should have been at 13, right? But because you've added value to this, right, it should increase it by 10,000. And what you're going to do is you're going to recalculate everything. So that means the next month, right, it should be now at 31,000 compared to the previous one. So you had to go through the whole entire depreciation again until you get to the 49th month, right? And you're going to get a different depreciation rate, expense, and everything, right? Because now it's 1/8 instead of 1/5. Okay? So you're going to go through all the things again to get to the conclusion that now your book value should be now 31,926. Okay? So that's the two methods that you can do to calculate depreciation when you add any fixtures or restorations or wanting to add it. I think the easiest way is just to do the first method, which is to add the value to your book value. But if you do that, right, once it reaches the end of its life, like we've mentioned before, right, yes, it can keep going, but just know that, you know, even though you're depreciating the same amount and it's going to last you for 3 more years, right, that's fine. As long as your book value does not go below salvage value, you'll be okay. Okay? So those are the two methods of what you can do when you're adding value to it, right? How do you adjust it to your depreciation? And that's what you do. Okay? Any questions there? Okay. So let's talk about what if I want to exchange my fixed assets. So again, that's one of the things you can do too. So a common one is vehicles. Okay. Let's say I want to I go to an auto dealership and they say, let me buy out your used old car and I'll trade it in for a new car, or you could get a used one, doesn't matter, right? I could trade it in for a new car. It's going to last you a lot longer. Its mileage is great, and so on and so forth, right? So you're doing a trade-in or buyout value, right? So in this case, what this kind of fixed asset, when you're trying to trade in, is there's a few extra steps to this. So let's say I wanted to trade a small little sedan car and trade it in for a truck. Okay? When exchanging between fixed assets, you must consider the fair market value of the fixed assets. Okay? Book value is what is in your books and what you valued it at. Fair market value is where you have to actually seek somebody for an appraisal, and they're going to tell you what the value of the car is. Okay, so that's the difference between what your book value is versus what the fair market value is. They're telling you after doing an appraisal, this is what your car is actually worth. Okay? So in this case, right, let's go ahead and look at this example here. On January 10, you decided to purchase a small sedan for $35,000 on a car loan. Okay. And of course, you put a down payment of $2,000. Okay, assume that all fees and taxes are included. So let's go ahead and record that we purchased this vehicle on a car loan and so on and so forth. So here you have your car, right? It's for $35,000. You put a down payment of $2,000, and now you owe a loan for $33,000. Okay. So therefore, let's go ahead and depreciate it for the first year. So in this case, right, you're supposed to get at least $5,000 out of this car. This car can last you about 10 years, and the date that it placed into service was January 10th because you bought it on January 10th. So in this case, I'm going to depreciate. Let's say I use this car for the first year, and this is it. I'm using straight line once again. So this is what it looks like, right? This is the depreciation expense that you're supposed to do every year, which is $3,000, right? 30 minus 5 is your basis times rate of 10% gives you $3,000. So in this case, for my first year, I dropped my book value down to $32,000. Okay? And let's say on December 25th or 28th, okay, so of the first year, the car dealership, okay, offers to do a trade-in value, okay, wants to trade your used sedan and upgrade it to a new truck, okay, which has a fair market value of $30,000. Okay, so that's the price that they're trying to sell it to you is at $30,000. Okay, and of course you go to the dealership to get an estimate of your fair market value on your sedan. Okay, which gave you a total of worth of $30,000. So they said, hey, even though on your books you said that your car's worth $32,000, they say, well, after wear and tear, you used it, you drove off the parking lot. So therefore, in our books, we say that this car's worth $30,000. So that's the fair market. That's what the appraisal said. Okay. So let's go ahead and record the implied loss. Okay, and then trade in the car for the truck. Okay. So this is where we have to do applied loss, right? So in this case, I need to recognize my first thing is how much depreciation did I use? In this case, I only used $2,000, right? Or $3,000 because that was one whole year's worth of depreciation. Okay? The vehicle that I bought was originally $35,000. Okay? The truck that I want is $30,000. Okay? And now I need to recognize this, that I have a loss on disposal because they told me that my car value right now is worth $30,000, not $32,000 that we have in our books. So therefore, I have to take a $2,000 loss because I originally bought my car at $35,000. I used it for 1 year. My book value is $32,000, but they went through appraisal and told me no, it's only worth $30,000, and I can do a trade-in value for a $30,000 truck. So that's what you have to do. You have to do a loss on disposal of asset. So there you go. All right. And that's what you do when you do a trade-in or buy-out value. All right. Any questions there? Okay. All right, so last one is going to be the abandonment of an asset. So, as we've mentioned before, right, there'll become a point in your list of fixed assets where it's not realistic for you to resell it or to get any kind of dollar out of it. Because let's say, remember that example that we used in the class where we bought a laptop and you already used it for 7 years. Do you think you're going to be able to sell it for any amount over? Remember, it gave us $84 at the end of the 7 years. Is anyone going to buy a laptop from you for that 7 years old for $100? Probably not. They'll probably take that $100 and put it into a new brand new laptop that they can use for even longer. So in this case, this is where we can choose to just abandon our fixed assets, right? Where we just need to just get rid of it off our books because there's nothing we could really do to it, right? You can't sell it to gain any money out of it. You can't exchange it for anything because it's not going to give you any value out of it. So in this case, when an object or a fixed asset it reaches the end of its life, it's at its end, it's reached its also end of its capacity for depreciation, right? Once it's exhausted to this point where you just can't do anything without it, you just want to get rid of it off your books, this is what you do, okay? So let's go ahead again, another example here on December 31st. You decided to buy, okay, you drove your truck at the end of its useful life of 10 years, okay, and it has a salvage value remaining of $2,000, okay, and of course you originally traded your sedan for the truck value of $30,000, okay, and you decided to abandon this truck, okay, at a junk yard, okay. So in this case, let's go ahead and take a look. How do I get this truck off my books? Well, we got to recognize three things. First, we're going to definitely take a loss on disposal of asset because right now I still have a book value left on it or a salvage value left of $2,000. Since I'm just going to throw the truck away and not try to sell it at all, that's $2,000 I already lost right there, okay? I also have to recognize the accumulated depreciation I had on that truck, which is to $28,000. And of course, I bought the truck for $30,000. And that's it. That's how you just get rid of it. So in this case, I took a loss for $2,000. All right? Any questions? Okay. So let's go ahead and talk about 11.6, which is goodwill and impairments. Okay. So what is goodwill? All right. As a means of a business, this happens all the time where companies buy into other companies and they do a hostile takeover, right? Now, this is how businesses grow and how businesses, because there's so many small businesses out there, there's always someone that's looking for help or they just want to buy out a business itself and take over its assets and, either renovate it or make a name out of it or just basically just acquire the entire business and completely wipe it off of its existence, right? So in this case, when we're doing this, when we find out what goodwill is what happens when you buy out a company for more than what it's actually worth. Okay? Therefore, you gain invisible value that go towards your asset because goodwill is a means of a type of value when you acquire a business, right? It could be a business name, it could be patents that a business has that you could use for your business, okay? So that's what this is. And it's important because this is very important because if you are looking into buying a business, right? If you already decided what kind of business that you want and instead of making your own business, you want to buy an already existing business, this is what you're going to be looking for, okay? So here's an example here where XYZ company is, here's their balance sheet and this is their book value. So they have cash of $25,000, accounts receivable of $36,000. They have inventory that's worth $15,000, and they have fixed assets of $56,000. Okay, and they have loans of $50,000 and an equity of $82,000. So in this case, their books has a balance of $132,000. Okay, this is their book value. Now, same thing when you're going through buying a business, you have to go through an appraisal to find out what is the actual fair market value for this business. So that's what you're going to do. You're going to determine the fair market value. So in this case, cash can't be devalued or add value because cash is cash, right? If you got $25,000 in the bank, it's still going to be $25,000 in the bank, right? Accounts receivable, which is the money that customers owe you, right? If they owe you $36,000, it's not going to change. So it's still going to be $36,000. However, your inventory can change because remember, right? When you sell this inventory, you can sell it for a lot higher than what it's actually worth. Okay? So in this case, it's increased to $40,000 worth. Your fixed assets as well too. Maybe when they record it in their books, but you have the potential to sell it higher. All right, so this would increase to $100,000, and you found out that they had a patent for $10,000. And again, you're gonna minus out your loans of $50,000. So right now, you have a total net assets or net worth of $161,000. So in this case, if you acquire this business, you're going to get potentially goodwill. So my fair market is at 161. My previous book value was 132, right? So in this case, you just gained roughly 39,000, right? So let's talk about actually acquiring the business. So let's say you ran the business through the appraisal, and it told you that you have $161 worth of assets that you can acquire. In this case, I'm going to say, great. I'm going to offer to buy this business for $200,000 because it has $161,000 worth of assets that I could get rid of and basically potentially gain that money back. But I'm going to buy this company out for $200,000. So this is what you're going to do. Since you're acquiring the business, you're going to acquire all the assets, including the liability and so on and so forth, right? So here, I recognize that I'm going to acquire the cash. I'm going to acquire the accounts receivable, acquire the inventory, fixed asset, and the patent. And they're all going to be at the fair market value because that's what they told you that it's being sold for. They appraised it for you. And they told you that you also have to pay off a loan. So here's this, right? There's the company right here for $161. You paid $200,000, right? So what's the gain that you got out of this? If it was $161 and you paid $200,000, you gained $39,000 worth of goodwill, right? It's invisible because, right, you spent money to buy a business, right? The business itself, right, isn't a tangible asset. It's not an intangible asset. It's more or less itself is going to be considered goodwill, right? You can't categorize buying a business as any of the following, right? It's definitely not a current asset. It's not a fixed asset. It's not an intangible asset either, right? It's just going to be goodwill, which is something you can't touch, right? You created money out of thin air. So that's what this says right here, that goodwill, that's what you gained when you bought the business for $200,000. Okay? All right? And impairment. So when you always have goodwill, you always have to test to make sure it never becomes impaired. So that means every year they do require you to test for impairment because, again, when you have a business that you acquired, right, because as you go through its years, right, it's not going to hold its value. Just because you bought the business for $200,000 and you don't use anything in the business, right, it's going to lose value significantly because you're not keeping up the value of that business. So that's the same idea here where you're eventually going to lose value in your business every single year, or given or take between its lifespan. Okay? So here, for example, company ABC, we purchased company XYZ for $200,000, which gave us a $39,000 goodwill. Okay. All right. Of course, its fair market value of the net assets of the company XYZ valued at 175. Okay. For So now we're going to test the goodwill for impairment. So now we're revaluing what the company is now worth. The company is now, fair market value has increased. It was 161 when we bought it. Now it's now worth 175,000 now. And we originally bought it for 200. So how are you going to figure out this impairment? This is what you do. Okay? You're going to first figure out the implied value of goodwill. So by doing so, you're going to take the fair market value of XYZ company, okay? And then you're going to less the carrying value of goodwill. So in this case, what was it previously? Well, it was previously $161 $61,000 when I bought it, right? So this is how you figure out what the carrying value is. I get a total of a $14,000 difference, all right? And this is my impaired value of goodwill, right? It increased. So therefore, I lessen my goodwill. And then once you do that, then you're going to test it by taking the impaired value of goodwill of the $39,000 and compare it to the difference that it made now. So in this case, when I purchased the business, it gave me $39,000 of goodwill. And now I need to subtract that $14,000 to tell me that my loss on impairment was $25,000, right? 39 minus 14 gives me a difference of 25,000. So in this case, that means I have to adjust my books accordingly, because now it's 25,000. So that's how you test for impairment. All right. Again, I'm not going to test you on this, but this is just to give you some information, especially when you do acquire a business, right? Just because you acquire it and you got goodwill out of it, that doesn't mean you can't, it stops there. You have to test for impairment every year, right? Any questions in regards to 11.5 and 11.6? So we talked about getting rid of assets, and then we talked about buying a business. Okay? Any questions? Okay.